Hi, I'm Scott Barnard. I'm a fixed income portfolio manager at Westwood, and we wanted to spend some time going over both December and 2025 market performance. If we turn to our first slide, we see broad market returns. The S&P 500 was essentially flat in December, up just 6 basis points, but this capped a strong year up nearly 18%. The big story remains market concentration, with the S&P up almost 18% and the equal weight and Russell 2000 up just over 11%. This continues a multi-year theme of mega cap dominance. Despite headwinds all year, including the DeepSeek shock in January, tariff volatility in April, and the 43-day government shutdown, the Nasdaq once again led the charge at up 21%. This shows that the AI narrative proves durable. December saw some rotation towards value and cyclicals. Potentially, this is a setup for 2026 broadening of performance. Turning to fixed income, yield curve steepening was the fixed income story of 2025. We finally exited the longest curve inversion of history. 2s 10s is now positive at roughly 70 basis points. Historically, this uninversion has been a better recession predictor than the inversion itself, but this time may be different. The Fed is cutting preemptively to support employment, not reacting to a crisis. It's notable that 10-year yields backed up 16 basis points in December despite another rate cut. The market is pricing in either sticky inflation or some combination of deficit and supply concerns. Corporates had a relatively benign year. Spreads momentarily widened in April, but quickly snapped back to historically tight levels. High yield spreads compressed from 287 basis points to 268 basis points. And in a year with this much noise, that's really quite remarkable. Looking at year-to-date performance, credit was the right trade in fixed income, with high yield up over 8.5%, investment grade up just under 8%, and the average treasury up only 6.3%. Turning to our next slide, we'll look at some of the performance within equity sectors. 10 out of the 11 sectors were positive year-to-date, which shows a healthy backdrop even with narrow leadership. Communication services and information technology tell the AI story. These two drove the index despite periodic scares. Real estate was the lone loser, and this makes sense given where the long end of the curve went throughout the year. There were some notable rotations in December. Financials and materials led, utilities gave back over 5% after a strong year of performance on data center hype. Consumer discretionary was only up 5% on the year despite a resilient consumer. It's possible the market is pricing in some caution on the lower income cohort. On our next slide, we look at some of the fixed income performance in more detail. Lower quality outperformance continued in December, with double Bs up 40 basis points and triple A's down on average 1%. Short maturity bonds outperformed long maturity bonds, which is consistent with the curve steepening dynamics. On a year-to-date basis, 7 to 10 year was the real sweet spot of the fixed income curve. Spreads remain tight across the quality spectrum. Credit conditions look benign, though, heading into 2026. Now we'll turn to our capital markets outlook. Our base case is for better than trend economic growth. We think the Fed will continue to move towards neutral and financial conditions will remain stable. Some of the key assumptions include a roughly 10% growth in earnings per share. We think the Fed funds rate will end up around 3 to 3.5%, with real GDP growing on average 2.3%. The upside risks are that trade deals materialize. We have this art of the deal moment and consumer confidence rebounds. On the downside, we could see trade wars return, we could see stagflation, or we could see that the return on investment on AI investments doesn't materialize. That said, the Fed put remains in place as shown by 3 well-timed cuts in 2025 supporting markets throughout volatility. Looking at some of the asset classes in more detail, we remain constructive on equities. We believe that earnings will be resilient, and we do see a potential broadening to small and mid cap away from the mega cap performance. Within credit, we remain neutral given the overall tight spread levels, but there does continue to be decent risk return with elevated all-in yields. We think interest rate exposure continues to serve as a valuable insurance policy, although the long end may remain a bit sticky on inflation and supply concerns. And lastly, we look at the chart of the month. 2026 kicks off year 2 of President Trump's term, and historically this has been a bit more challenging for markets. Valuations remain elevated, but this is by no means a sell everything signal. 2025 proved that markets can climb a wall of worry, and we remain constructive but vigilant heading into 2026. Overall, 2025 was a year of resilience. Heading into 2026, we're constructive on the outlook, but mindful of valuations and watching the consumer closely. Thank you everyone for joining us, and we look forward to talking to you again next month.